Good day, everybody. Today, I'm very happy to have Michael Lawrenson here with me. Mike is one of the founding members of Tantalum Capital and is also our head of equities. He manages all of our equity portfolios, and for his sins, he's also our resources expert. Mike, thank you for joining me today.
Thank you, Simone, and good morning to everyone.
Mike, you've been in the market since 1998, so you've seen a number of different crises unfold. How is the crisis that we're living through today different from a money management perspective than the other crises that you've seen?
Well, it's weird because when I started in the fund management industry in 1998, I actually joined at the back end of the Asian crisis. I then lived through the tech boom and bust in 2000, September 11, and obviously the global financial crisis in 2008. In my view, I think it's much different this time. And the reason for that is I think the impact on the global economy is much broader and much deeper this time around. Corporates and governments were ill prepared for the almost instantaneous and synchronized shutdown that we saw hitting the global economy. In my view, it was like a revenue strike. Essentially, consumers, corporates, and governments significantly reduced consumption and expenditure across almost all categories. I guess the million-dollar question is, has human behavior changed, and as an extension, have human consumption patterns changed as a result? And are these changes likely to be permanent? If we sort of consider what's happened, central banks have injected significant amounts of liquidity into the financial markets in an effort to minimize the impact of this pandemic on the global economy. As a result, we've seen a significant rebound in equity markets globally, and especially in the USA, as a direct consequence of this liquidity injection. But I mean, if you really think about it, the Wall Street share prices, in my view, do not accurately reflect the current grim economic reality that is currently pervading Main Street USA.
Mike, given the macro environment that we find ourselves facing in South Africa at the moment, are you finding opportunities in equities to invest into?
Yes, we are. It's a tough market out there, but we are. The SA macro environment was already poor, and that was pre-COVID and the hard lockdown in March. I mean, our economy is in dire need of economic, social, and political leadership. Business and consumer confidence remain at historic lows. And, there's some easy wins. All we need is some clarity on labor and energy structural reforms. And obviously we wait the much anticipated wait for the release of 5G spectrum. Having said all those bad things, despite, this poor environment, there are some world-class South African businesses out there that have top management teams and in our view are currently valued on depressed ratings and depressed earnings. As a house, we had become a little bit more positive on SA Inc. In the 12 months leading up to the first quarter of this calendar year. In hindsight, we were probably too early, but fortunately, we hadn't increased our exposure significantly. So, we've been using the current sort of price volatility to selectively pick up some SA exposure. I mean, some of the examples would be, if you look at the mining space, South Africa's got some world-class mining companies that obviously have benefited from the weaker rand-dollar exchange rate, and certainly will reap the rewards of higher dollar commodity prices when the global economy recovers. In terms of the industrial and financial sectors, we focus our attention on those companies which we consider to be trading below normalized fair values, which have strong management teams and have conservatively positioned balance sheets.
Mike, it certainly sounds like you are finding opportunities within the South African space. How has your positioning in the portfolio changed over the last 6 months?
Yeah, there's been a lot of extreme price volatility, and in some cases we've used the opportunity to reposition the portfolio. If I start off with the sells, I guess 2 key sells or / reductions during the period were where we reduced our holdings in both British American Tobacco and Northern Platinum. I mean, we've had very good absolute and relative performance from both these counters, and we've used the opportunity to crystallize this performance. We've also exited the entire positions in both Barlow World and Tiger Brands, and this was on the basis that our investment case had been revised. In terms of other recent additions to the portfolio, from a mining perspective, we added both Assor and Anglo American Platinum to the portfolio. In the case of Assor, we've actually subsequently exited that position, and that was on the back of a minority offer, which resulted in the delisting of the company at a significant premium to our entry price. Our investment in Anglo American Platinum was based on the events and the share price events, I guess, following the announcement by the company that they were putting their 2 converter plants on hold for 9 months while they underwent repairs. Using our assessment of long-term PGM prices and our view that the share price had overreacted on the downside, we used the opportunity to buy what we consider one of the world-class PGM assets in the world. Then during the last 6 months, we also used the commodity price and share price volatility to add selectively to our preferred mining exposure. And in this case, it's the diversified miners, BHP and Anglo American. So we added to both of those in March and April. And, we've seen a significant recovery in mining shares and commodity prices globally. And in some cases, we've actually used the recent weakness to actually sell some of the shares we acquired in the late first quarter, early second quarter. If we turn to SA Inc., there we've bought AVI, we bought Life Healthcare, and we have bought Remgro. AVI, we believe we're buying the national brand business at fair value. It's a strong and reputable management team, and it's got a very conservatively positioned balance sheet. Looking at the healthcare space, quite clearly, the healthcare space is currently in the eye of the COVID pandemic. If we look through that, we believe that the fundamentals for the healthcare industry remain strong, and we've used the extreme price weakness to recently add both Life Healthcare and Netcare to the portfolio, with Life Healthcare being our preferred counter.
Mike, given these insights, what is your highest conviction position in the portfolio at the moment, and why?
Yes, Simon. British American Tobacco remains our highest conviction portfolio position. Earnings growth has historically been in the high single digits range, and bar the recent impact, largely emerging market related, FY20 guidance has been reduced to mid-single digits. We believe it's attractively valued on an 8.5 times forward PE and a dividend yield of 7%, and makes it a key holding in our portfolio. In terms of South African equity portfolios in general, I guess no discussion is complete without mention of Naspers and Process. Obviously, the key driver of the valuation of both of those remains the investment in Tencent itself. there we remain bullish on the underlying fundamentals in Tencent itself, which is obviously online gaming, fintech, and online social networking platforms. We do, however, believe that the risks from a valuation perspective have significantly increased in both absolute and relative terms in the global tech space. I mean, globally, tech stocks have seen a significant re-rating in the last 6 months, and market values in some cases have doubled or quadrupled in the last 6 months. And Tencent's investments in listed associate companies has substantially benefited from this re-rating. Despite this, we remain content with our combined holding of around 13% in these two shares, and we will continue to evaluate Tencent's earnings growth, prospects, and valuation, and obviously take cognizant of the discount levels at which Naspers and Processor trade to their underlying investments.
Mike, last question from me. Could you perhaps share with us one lesson that you have learned, or at least a reminder of one, in the last 6 months?
Yes, Simon. For me, the COVID pandemic is a classic reminder of how real black swan events can be, and I guess more importantly, how such events can impact your portfolio. On top of that, it also has, for me, reaffirmed how important balance sheet analysis is when selecting companies that you want to add to your equity portfolio. I mean, without a doubt, those companies that have relatively strong corporate balance sheets have survived this crisis, this pandemic, far better than those companies with weaker balance sheets.
Mike, thank you so much for your time today. It's always a pleasure to be able to chat to you. Good luck in the coming months, and we hope to speak to you again soon.